The stock market is often described as a barometer of economic activity, a reflection of investor sentiment, and a tool for wealth creation. But every now and then, whispers of overvaluation grow louder, prompting investors to ask, is the stock market overvalued? The answer to this question isn't straightforward. It requires understanding historical trends, evaluating current metrics, and accounting for market psychology. Let's dive into the factors that can help answer this pressing question. P/E ratios and beyond. To determine whether the stock market is overvalued, one of the most commonly used tools is the price-to-earnings (P/E) ratio. The P/E ratio compares a company's stock price to its earnings per share. When applied to the entire market, such as the S&P 500, it gives a snapshot of how much investors are paying for each dollar of earnings. Historically, the average P/E ratio of the S&P 500 has hovered around 16 to 10. However, during times of economic euphoria, this ratio can soar. For example, during the dot-com bubble of the late 1990s, the P/E ratio climbed above 40, signaling extreme optimism. As of today, the S&P 500's P/E ratio is above its historical average, sitting in the mid to high 20s. This number suggests that stocks are relatively expensive, but it's not the full story. Consider another metric, the Shiller P/E ratio, or the cyclically adjusted P/E, CAPE ratio. Darnhow ratio. This metric smooths out earnings over a 10-year period to account for economic cycles. The current Shiller P/E ratio is significantly higher than its historical average, raising red flags for some investors. But high valuations don't always lead to immediate declines. For instance, the market's P/E ratio was elevated for years before the eventual crash in 2000. To understand these metrics, think of buying a house. If homes in your area typically sell for $300,000 but are now going for $500,000, you might worry about overpricing. But if interest rates are low, making monthly payments affordable, or if the area's desirability has surged, those high prices might be justified. The same logic applies to stocks. The role of low interest rates and liquidity. Low interest rates have played a massive role in driving stock prices higher. When borrowing is cheap, companies can invest in growth, and investors are more willing to pay a premium for future earnings. Let's say you're choosing between a bond that offers a 2% annual return or a stock that could yield 6% but carries some risk. In a low interest rate environment, the stock's potential return becomes much more attractive. Central banks, including the Federal Reserve, have also injected trillions of dollars into the economy through quantitative easing. This liquidity has found its way into the stock market, pushing prices higher. In some ways, the market's valuation may not only reflect company fundamentals, but also the sheer volume of cash-chasing investment opportunities. Imagine a scenario where a bakery's cupcakes usually sell for $3 each. If suddenly everyone in town receives a $100 gift card specifically for baked goods, demand skyrockets, and the bakery can charge $5 per cupcake. That's essentially what happens in the stock market when liquidity floods the system. Prices rise, but not always because the product, or in this case, the underlying earnings, has improved. However, low rates and high liquidity can't last forever. The Federal Reserve has already signaled potential rate hikes, which could dampen market enthusiasm. A shift in monetary policy often acts as a reality check for inflated valuations. Fear, greed, and speculation. The stock market isn't just driven by numbers. It's also influenced by human psychology. Greed pushes investors to chase returns, while fear causes sudden sell-offs. During periods of overvaluation, market sentiment often leans heavily toward greed. Think of the meme stock frenzy of 2021, where companies like GameStop and AMC saw their valuations skyrocket due to speculative buying, not fundamental strength. Exuberance isn't limited to individual stocks. Cryptocurrencies, NFTs, and SPACs, special purpose acquisition companies, have also attracted massive inflows, reflecting a broader risk-on mentality among investors. While these trends can coexist with a healthy stock market, excessive speculation is often a warning sign of an overheated market. To quantify sentiment, analysts often look at the Buffett indicator, which compares the total market capitalization to GDP. A ratio above 100% suggests that stocks are overvalued relative to the economy's size. Currently, the Buffett indicator is at an all-time high, exceeding 200%. This level of overvaluation has only been seen before major corrections, such as in 2000 and 2008. Comparing current conditions to historical bubbles. History doesn't repeat itself, but it often rhymes. To gauge whether the stock market is overvalued today, It's helpful to compare current conditions to past bubbles. The dot-com bubble, for instance, was characterized by sky-high valuations for companies with little to no earnings. Today, a similar trend is visible in some tech stocks, where valuations are based more on future potential than current profits. Consider Tesla, one of the most debated stocks in recent years. Its valuation soared to a level where it was worth more than the next several largest automakers combined, despite producing only a fraction of the vehicles. While Tesla's innovation and market dominance justify a premium, its valuation highlights how growth expectations can sometimes overshadow reality. Similarly, during the housing bubble of the mid-2000s, home prices rose far beyond what average incomes could support. When the bubble burst, the market corrected violently. Today's stock market shows some parallels, particularly in niche sectors like electric vehicles and renewable energy, where hype may be outpacing fundamentals. Is the market always right? Despite concerns about overvaluation, long-term investors have historically been rewarded for staying in the market. Even if stocks are overpriced today, a strategy of consistent investing can mitigate the risk of buying at the top. Over the past century, the stock market has delivered an average annual return of about 7% after adjusting for inflation. This trend underscores the importance of time in the market rather than timing the market. Take the example of an investor who began investing $500 per month in 2000, just before the dot-com crash. By 2020, despite enduring two major bear markets, their portfolio would have grown significantly due to the market's recovery and compounding returns. On the flip side, someone who tried to time the market and stayed out during periods of uncertainty might have missed some of the best performing days, significantly lowering their returns. While it's tempting to worry about whether stocks are overvalued, the bigger question is whether you're prepared for volatility. Diversification, regular contributions, and a focus on long-term goals can help you navigate even an overheated market. So, is the stock market overvalued or just misunderstood? The evidence suggests that valuations are high by historical standards, fueled by low interest rates, abundant liquidity, and investor optimism. Metrics like the PE ratio, Buffett indicator, and CAPE ratio all point to elevated prices. However, high valuations alone don't guarantee an imminent crash. The stock market's resilience and long-term growth potential mean that investors who stay disciplined can still achieve their goals. Rather than fixating on whether the market is overpriced, focus on building a strategy that aligns with your risk tolerance and financial objectives. Markets will always fluctuate, but a well-planned approach can help you weather any storm or bubble that comes your way. So with this knowledge, how do you beat the market? Check out this video about the Grand Master of Investing, Warren Buffett.